Again, we are joined by another fund manager from the sidelines of Morningstar Conference 2018. This time we have Shailesh Bhan, the Deputy CIO of Reliance Nippon Life Asset Management. Shailesh, always wonderful to chat with you. We are having this conversation at a time when Nifty is down some 12-13% on a year-till-date basis, and the broader markets, small cap, mid cap, the damage has been much more, 40-50%. As a fund house, how are you approaching this bearish phase in the market, if you will?
See, after a very strong outperformance, markets have corrected. So it's been a very good phase of 2017. In fact, 2013 to 17 was a very, very big run, right? After that, we have seen in pockets of the market, valuations had gone into very expensive zones, especially the small and mid cap places, where we have seen a pullback. Generally, good quality businesses which were rationally valued have done well even in this environment. And hence the differential, 2 years back the talk was mid caps used to outperform large caps, and their premium to their valuation was 20, 30, 40% higher. Now that has given away. So I think the distortion which was there in terms of relative valuations of large caps and mid caps is corrected. So our approach is simple. We're looking at, from a 3-year point of view, which kind of businesses have an earnings momentum in their favor, directionally seeing an improving operating environment, and tailwinds for those companies, how supportive they are. I think that is the construct which we are approaching to do investing. We continue to believe the large cap space is still rational and has over a 3-year period a good opportunity, and over a period of time people can look at other spaces as well. But at the moment, given elections and given you have volatility around, the large cap or multi cap space is a better space to be in.
Shailesh, talking of volatility, the latest leg down in the market was triggered by which appeared like a liquidity crunch in the system, and NBFCs sold off big time. Financials overall followed. At your house, how did you observe this? Now commentary coming in from some large NBFC companies like Bajaj Finance that it's not a 2013 like situation, and people were awaiting that commentary from that sized company. How are you analyzing this kind of event which has panned out, and which are the kind of companies from the NBFC space which you think will survive the shock, and which are the ones which may fall by the wayside?
See, NBFC has a very good run in the last 3-4 years. You had other challenges in the banking sector which created a very good runway for non-banking finance companies to lend and grow, right? And in that phase you saw many companies, companies with strong capabilities doing exceedingly well, and companies with average capabilities also getting a good reward in the market. So it was kind of a semi-bubble in NBFC companies at the point of time. Now after things have changed and easy money is not available to lend, I think you will find companies who have significant strong retail presence, who have strong credit processes which can handle the volatility or the changes which are happening in the credit market. I think those sets of businesses are very well placed. NBFCs play an incredibly important role in the system, right? And those who are able to have an advantage in terms of retail distribution, better management practices and all that, have a long way to go. I think that journey will still be there. And companies who are just an arbitrage from what was available, there was a kind of a period where banks were not lending, and that was available as lending for other places. I think that those segments will be challenged. So retail-driven franchises with reasonable ability to manage liabilities are very well positioned.
So you mean to say that though right now the market may be giving the same treatment to the entire space, but eventually the retail-oriented ones and good quality managements will rebound, whereas other may actually consolidate because the business model now has not completely got shaken. But you're still saying that the structural story is intact.
See, the need for NBFCs is what? Where banks couldn't reach. So India is a large country. There are a lot of products where banks has not reached because it takes that much time to penetrate and do that risk profiling of customers and do it. And so there was a huge window where real traditional banking was not there. I think NBFCs had a significant role to play, and they still have a granular, significant role to play. Wherever there was lazy banking, NBFCs got an advantage there to reach to the customers and get it. So there are still a lot of places where credit is required, which now you have tools also to monitor, manage, retrieve, and handle the whole process. So I think those sets of businesses have a good long-term opportunity.
Mm-hmm. Before we come to what your activity level has been in the market in terms of overweights and underweight, just a quick sense on the the kind of correction which has happened in the market. You have seen several corrections and boom phases. The way it has panned out, I'm not asking you to forecast the way forward, but a general sense you're getting, how much pain do you think exists and how many months could this actually last in your view?
I will take it like this. What happens is you have seen a 4-5 year run, right? I mean, it's been a substantially elongated run, right? And some of this run was also on the back of strong earnings in certain sectors, which were given significant valuation by the marketplace. So markets actually was in some sense split into two pockets. One segment of the market being overvalued for the growth they were delivering, and other pocket was undervalued because there was no momentum in that spaces. I think this correction has brought about a lot of rationalization and I would say sense in valuations. Now you're getting in many pockets reasonable rational businesses to participate in. And I believe an investor, primary thing for him is valuations in his favor. So I think you'll find money chasing good value, money chasing good businesses, money chasing companies with good longer term outlooks. So you'll find at various valuations you'll keep getting investors wanting to participate in it. So our cases, valuation corrections have already been sharp. It's been there. And directionally, we've always been advising larger cap investing from a 3 or 4 year horizon, because where the valuation of the market were in small and mid cap categories, we still think that opportunity exists. And the whole earning opportunity or earning recovery in India, which has not yet happened in many pockets of the market, can also slowly start delivering.
Convinced that this earning recovery theory, which has been eluding us for so many years now, and which emboldened the bears in the market a whole lot, that look, earning is not coming. You're convinced that in the next 3-4 year period, there could be a phase of earning expansion. Market may move in tandem or not.
That's a different thing.
That's a different thing, but earnings will definitely move up.
See, the possibility of earnings coming back in many pockets of the market exists, or many segments of the market exist. To your point that whether, it's not done in the last 3 years, India did some of the biggest reforms ever it's seen in the last 3 years. It does impact, right? Then you had global volatility and challenges also there. I think the macro conditions generally when you're operating will normalize. The minute that normalizes, you'll find underserved markets, underserved customers delivering earnings for a lot of our corporates. So I think we have a good earning cycle ahead of us, right? It can only be disrupted by very big macro events. Very big macro events. Something has to go wrong, oil goes $20, $25 higher or something which takes away that whole thing. But I think significantly at the stage at which India's economic growth is, the stage at which corporate profits as a percent of GDP are, the possibility of earnings expanding only keeps on increasing as we look forward.
Shailesh, what would your approach be to rupee sensitive sectors like IT and pharma, in the light that everybody knows that rupee weakens and these guys' margins get aided. Even the clients know that. So a lot of time possibility that the entire agreements on pricing actually get done lower. So which side of the argument would you look at?
You're right. I think a lot of price rupee depreciation, especially when you have strong buyers on the other side, it has to be passed on. So you'll find in different segments of the market, different industries, a different level of pass on happens to it. So if you have large corporate customers, you need to pass it on there, right? I think you have to see rupee depreciation independent of specific sectors. I think India was in a flat currency environment for 5 years. It was like 58, 60 to a currency for 60 to a currency for a 5 year after 2013, right? So it's been a significant period of, in some sense, overvaluation of our currency. That has given away. So that is one. Second is, many sectors benefit than just IT and pharma. A lot of our engineering exporters benefit. They become competitive, because competing economies corrected even more materially than in terms of currency there. So I think rationally, it's generally earnings positive as an event. The degree is not to the extent the currency depreciation is suggesting, because you have to definitely pass on in a lot of areas. And hence, you have to be, wherever you have pricing power or granularity in terms of, end customer not having so much bargaining power towards it, those spaces do offer good margin upsides to companies.
Let's talk about pharma, a space which you look at very closely. The one pocket which has stood out in the middle of this volatility is MNC pharmas. In fact, some of the rare interactions, Abbott was on our channel recently, very good management commentary. How are you looking at MNC pharma opportunity versus the valuations they are trading at?
Yeah. There are two aspects to that. Primarily MNC pharma companies in India are domestic focused. So 80-90% of their revenues come from the domestic market. Domestic market is like, we are at the hotbed of, I call it a disease crisis or, challenge in India, right? We have the largest number of cardiac patients, second largest number of cardiac patients in the world, second largest number of diabetic patients in the world. We have a lot of chronic diseases, actually, in some sense, developed country diseases with developing country income, right? And the penetration of pharmaceuticals in the domestic market is rising, but said there's a huge journey, as per capita income rises, treatment, diagnostics, everything happens. So the market, the domestic market, which is primarily the stronghold for a lot of multinational companies because they get 80-90% of the revenues from there, has a good double-digit volume opportunity for the next 10-15 years. In fact, it's the most understated fact that the pharma sector in India would have done double-digit volume growth in the last 10 years, the domestic sector. So I think it's a long journey, long runway. All the economics of these businesses are like consumer companies, and they don't need capital for growth. They generate reasonable good return on capital employed. They have a long sustainable growth opportunity in front of them.
What about the companies which are having regulatory issues in the pharma space, especially catering to the US market? And they put a lot of remedial measures in place and things have started to turn. In fact, Mr. Gottlieb, the new US FDA chief, is also tweeting a lot these days, saying how in a speedy manner a lot of issues are being solved across. What is your take on this pocket of the pharma?
There are 2-3 aspects to Indian companies selling in the US. One was you had plant-related issues. I think the sector goes through maturity, right? I mean, and regulations also keep on tightening over a period of time, right? So we had maybe 4 out of 10 large companies in India under regulatory scanner at the point of time. I think a lot of Indian companies are, in my judgment, have phenomenal managements in pharma space. And they have managed to work to correct these challenges. And we are now seeing that their process also been enhanced. They are trying to work out an approach which is, far more compliant, right? And we are seeing a lot of the problems actually ending. The bigger problem in the space was a few products in the US were making most of the money, and the stock markets were giving that very high multiples. I think that phase has corrected 2-3 years back, and that's what gives you the confidence that valuations have rationalized. Worst on pricing seems to be behind. Currency tailwinds in your favor in even international exporting companies. And in terms of manufacturing, India is perhaps one of the strongest pharmaceutical manufacturers in the world.
In fact, Mr. Hamid once said, interacting with us, that it's just about time that India may actually become the pharmacy of the world. So perhaps we are heading there. But another new opportunity which seems to be arising now is the China as a partner, both for manufacturing as well as exports. We barely give out $200-300 million worth of exports versus $18-19 billion to US. And now a lot of tie-ups are happening. Aarti did a tie-up. Stride's API business is looking. Glenmark's API business is looking for some partnership. Do you think this API manufacturing kind of opportunity, especially with the face towards China as an export, could be a new area of opportunity for Indian pharma, which is a good background?
See, the size of China as a country is very large, right? And it was never easily open to India to go there and set up businesses and be successful, right? We have seen when we interact with businesses and companies in the sector, we are seeing that opportunity is now opening up because the regulations which they are asking for launching products into China and all that are now compliant with what is internationally there. And it's, in some sense, India has, like we said, phenomenal marketing, manufacturing infrastructure and right costs, all approvals from all global regulatory agencies, and have the right framework to sell in those markets. So pricing is also right. In fact, we are ahead of China in actually regulatory compliance and selling in the US. In this industry, we are possibly multiples of size of China in how much we sell in the US. So it's like India's pharma story is possibly the most understated success of India in the last 15-20 years. See, I think we are in a little bit of an extreme oil price environment, right? So we have seen some challenges coming about there. Directionally, the valuations of this space and generally across a lot of public sector enterprises, the valuations are now nowhere near all-time highs. They're actually at significantly lower levels. So the valuation of the space is rational. Yes, market does want clarity when these kind of things happen, because there has been a cycle of the past of 2007, 8, 9. But I think valuations of the space are very rational and very attractive. They do price in a lot of risks.
Okay, my last question. On a 3-year basis, which pocket of the market do you think has the best potential and a case for a strongest overweight in your view?
I think 3-4 sectors. In fact, our judgment is what's been the performance of the last 5 years may not be the performance of the next 3-4 years. So our judgment is companies which have done well effectively, but haven't got the earning growth which is there in favor. I think that is what will start, wherever earnings will start rebounding. I think those sectors will be the performance of the next 3-4 years. We think corporate lenders generally have a very well placed platform, especially in a tight money environment. Somebody's with current account and saving account deposits actually become, the value is really known in these markets. And I think directionally, post NCLT and all that, I think these spaces appear very attractive.
What about metals? It's a global sector.
Yeah, metals. What happens is, yes, some of the Indian businesses are very good and they're very competitive and all that, but international factors determine a lot of value creation for shareholders in this, because pricing is finally an international event, right? So it does carry a lot of weight. So there are a lot of uncontrollables there. But on a valuation basis, are the valuations for this sector cheap? They are cheap, but prices are a little bit unpredictable there in terms of the end product prices of these products. So you do have more uncontrollables there, but the kind of businesses which we have in the metal space in India are very good.
All right, Shailesh, on that note, I'll let you go. Thank you so much for chatting with us.
Thank you very much for having me here. Thank you.